Hello. In this video we will be discussing momentum and corrections. Momentum traders are essentially trend traders who focus on the time and price levels of a currency pair. The overall rate of change in the price of a currency is called momentum, and it helps traders to understand the volume of a market. If prices are changing rapidly, the momentum is high and a large volume of trades will either be buying or selling a currency, pushing the prices in one direction. Both extreme high and low momentum readings are indications of the market being overbought or oversold. Market corrections, or Forex rollbacks as they are sometimes referred to, are price declines that put a stop to a trend. When the markets show strong uptrends, the prices escalate and the currency becomes overbought. Some traders will buy into this rise in the hopes of making a profit, although traders who bought earlier will consider selling. As traders protect their profits and fewer traders initiate new long positions, the price forms a peak and momentum slows until the reversal occurs. Unexpected economic releases and geopolitical developments can initiate a reversal too. Price momentum. The length and frequency of short-term price swings serves as a measurement of market momentum. Strong momentum is denoted by steeper slopes and longer price swings. Weaker momentum is represented by short price swings and shallower slopes.